Chapter 2 is about receivables. There are three main ideas covered in this chapter. First, we are going to talk about the types of receivables. After that, about the recognizing, valuing, and disposing of accounts receivable. And in the last part of this chapter, we are going to talk about the recognizing, the valuing, and disposing of notes receivables. So, when a company sells a good or service on account, meaning that the customer did not pay for what he purchased, then the amount sold is written in the company's balance sheet as a receivable. We have three different types of receivables. First is the accounts receivable, second, notes receivable, and third, other receivables. The main difference between the accounts receivable and notes receivable is that in the accounts receivable there is no interest to be paid by the customer, whereas in the notes receivable the customer needs to pay the amount he purchased plus the interest on the amount. Other receivables is not related to the trade, so it's not related to the customer. It's mainly due to employees for salary advances, refunds of income taxes by the government, and interest receivable on loans. So first we're going to start with the recognizing of accounts receivable, meaning when will the company record an account as accounts receivable. The explanation can be found on page 62 in your books. Before we start, you need to be aware regarding the terms that accounts receivable may have, such as, for example, let's say that accounts receivable has a term of 5, 10, and 30. What does this term mean? This term means that N30 is the maximum number of days the accounts receivable must be paid. So the accounts receivable must be paid in 30 days after the sales or service invoice date. This is the maximum days. However, if the customer pays the accounts receivable within 10 days from the date of sale, he will get a 5% discount. This is an example. The numbers can be changed as we will see in the coming examples. Now page 62, we have the first given. So assume that FixUp provides repair services for Danglo company totaling $25,000. So FixUp is providing services with an amount of $25,000 on account. On January 5, terms N18. On January 25, Danglo company pays the full amount. First, N18 means that there is no discount. The customer has 18 days to pay the whole amount. So first transaction is January 5. The company sold for $25,000. So accounts receivable to the client, Danglo company. Service revenue, since we provided a service here. It was paid on January 25. So 25 we have cash and accounts receivable. Since the accounts receivable was paid, so it will be decreased in the company. So it needs to be in the credit, and the customer paid the company, so the cash increased. That's why the cash is in the debit. This is an exercise found on page 62 and 63. This is the given in your book, and this is the solution. Here we also have an example on page 63. On February 1, FixUp sells $30,000 worth of electronics. So we are selling a product, not a service. And we have the terms 2, 10, and 25. So in this example, we have a discount. The amount was paid on February 26. So first, February 1, we sold on accounts receivable to Ronald, and sales revenue. Why sales and not service? Because we sold a product. It was paid on February 26, so it was paid after 10 days. So the customer will have no discount. That's why we have a cash and accounts receivable. Now let's see this example on page 63 and 64. On February 1, FixUp sells $30,000 worth of electronics to Ronald, terms 2, 10, and 25, the same given, but the payment was done on February 9. So February 9 is within the 10 days of the selling. So here the customer will have a discount of 2%. So First, we have cash. We have accounts receivable, the same as before. The accounts receivable is the total amount, it's $30,000, but the company will give Ronald a 2% discount on the amount purchased. So this is the discount amount, $30,000 times 2%, which is 0.02. So the discount will be $600. This is the sales discount on the debit side, $600. The cash that the customer, which is Ronald, will pay will be $30,000 minus the discount given to him. So actually he will pay $29,400. Now, what if the customer returned a part of the products he previously purchased on account? Here we have an example on page 64. On February 1, Fix Up sells goods for $30,000 to Ronald on account to terms 210 and 25. So February 1, accounts receivable sales revenue $30,000. On February 5, Ronald returns defective electronics that have a value of $2,000. So here the customer is returning the company products worth $2,000. So of course the accounts receivable of the customer will decrease. Accounts receivable decrease in the credit side. And we need to enter an account related to the return called sales returns and allowance, and it's in the debit side. On February 9, it's given that Ronald pays the balance due to Fix Up. First, since he paid within 10 days, there will be a discount of 2%. So we will register as, we will have the entries as in the slide before, cash, sales discount, accounts receivable, but here we need to pay attention that the accounts receivable of Ronald is no longer $30,000. Why? Because he returned products worth $2,000. So actually he needs to pay the company, and accounts receivable will be $28,000. 28, it's the $30,000 minus the $2,000. So the discount will be on the $28,000 and not on the $30,000. So we have the sales discount is $28,000 times 0.02. We have $560, and so the cash will be $28,000 minus $560. It will be $27,440. Okay. Exercise on page 65. This is the exercise, and this is the solution for it.